Thank you very much for everyone who's here today. Briefly introduce myself and introduce myself. So I'm Wen Yu Xiong. I am the Director of Marketing here at BCIC, and I work at Children Investment Advisors, which might sound familiar if you've seen the poster for the event today. And the speaker of the event is Todd Malay. So Todd Malay is the Managing Director of Children Investment Advisors, which is where I work. He joined Chode back in 2008 to manage the investment team. Prior to joining Chode, Todd was a partner at CCC Alliance, a consortium of family offices. During this time, he also served as the founding executive director of the Warden Global Family Alliance, the research center on family wealth and family businesses at the Warden School. As a consultant in the Boston and Madrid office of McKinsey & Company for 5 years, Todd specialized in serving financial institutions. Todd graduated from Dartmouth College in 1992, selected as an Rhodes Scholar, and obtained a Master in Economics degree from Oxford University in 1994. He then graduated from Yale Law School in 1997. Todd served as managing clerk for the Honorable Sandra L. Lynch on the U.S. Court of Appeals for the First Circuit after graduating from Yale Law School. Todd is also the chairman of the board of New York City Weightlifting, a nonprofit organization dedicated to reducing urban violence by working with young people at highest risk. Todd also served on the investment committee of the Noble and Green School. In addition, Todd is a passionate athlete. He most recently rode at the head of Charles last month. He regularly does over 50 miles mountain hiking and occasionally participates in Spartan races. He's a true Ironman and one of the most inspiring person I have ever met. Let's welcome Todd.
Thank you. Thank you. Thank you very much, Wendy. I think that the end of that deviated my official bio. I'm really happy to be here and happy to talk to all of you. I hope that we can make this as interactive as possible and maybe I'll ask a lot of questions along the way. So please feel free to raise your hand and I'd love to talk about what's of interest to you. I think I've been invited here to talk about two things. So one is how we operate as a family office and talking a little bit about what is a family office. That's something that has existed in the U.S. and Europe for a very long time, but I don't think it's familiar in China, given the great amount of wealth that's been created over a relatively period of time. The second topic is how do we manage money in this family office context? So what are the ways we approach investment management, and what are some of the ideas that we have now in the current market? So that's what I'm going to spend the next hour or so talking to you about, but I would love to get your questions on the way. And I'd like to thank all of you for coming out on Friday night to listen So the first topic is a family office. How many of you are familiar with that term? Okay, so there's a few people that have heard that. What a family office is basically the way that somebody who's very, very wealthy, with hundreds of millions or millions of dollars, organizes their life. And there are a variety of forms that a family office can take, but they all share certain traits in common. Usually they work just for the wealthy principal. And so they only have that person's best interest hired by the family to work. And so they have this independence, which is important. The second is that they bring a variety of different perspectives to bear.
Hello?
Hello.
Sorry, we cannot hear you online.
Okay. How's that? Is that better? We can certainly hear you. The second is this broad variety of perspectives. So bringing together investment professionals, legal professionals, tax advisors, and other types of advice, and all the different perspectives that someone with those kinds of resources needs to manage their life. And the integration is very important, because the last thing the family wants to do is be the referee between a lawyer and an accountant and an investment professional. All might be telling them a lot of different things, or blaming each other when something goes wrong. So it's very important to have that integrated perspective. And then the third element is trust. Obviously, if you have these skilled people that are all working for you, the worst thing in the world would be if you felt you couldn't trust. And typically that trust develops over time. You see that these people have expertise, you see them work in a variety of settings. And it's very common for families to actually prioritize trust over company. We see that time and again. Somebody used to be my CFO when I ran a business, now he's my investment advisor. Why? Because I trust him, not necessarily because he's a great investment. And so when we think about what do we have to offer, we as an outsourced family office need to be sure that we're responding to all three of these different traits. So our business model was created based on independence. We have no proprietary products. We don't accept commissions. And so we can offer truly objective advice. We're integrated in the sense that we have lawyers, a high caliber on our team. We have tax professionals. We have investment professionals. And we have been around a long time. So Choate has been in this business for more than 100 years and has been managing money for families for that entire time. You might ask, what is a law firm doing managing money? Well, it happens in Boston, and I think China may be part of the reason we have to thank for this. When the merchants went off on their ships for extended voyages to trade, they needed to trust somebody, needed to hand over their affairs to someone, and maybe they wouldn't come back. And in Boston, that was their lawyer. So the lawyer was more than just a legal advisor. They also handled business matters for the family. They made investment decisions. And this tradition of the Boston trustee arose. And Choate Holmes Stewart is very much a part of that legacy that we're still continuing today. So the way we're organized is to integrate these three broad types of service. And this is just kind of a diagram of some highlights of the way that Choate is organized and the types of services that we offer. Amongst this type of model, we are the largest. So we're close to $5 billion in assets, which is not huge compared to a lot of big financial companies, but it's very large when it comes to independent firms. And actually, we've gotten some nice awards, but one of the recognitions that I'm proud of is that we're one of the fastest growing independent wealth advisories in the country. And I think that really comes down to the model that we have in this family office concept. We have a variety of different professionals, as I said. So Wendy and I are part of the investment team. You see at the top, we have attorneys, we have trust advisors, tax professional operations, all in all, our group is about 80 people. And the aim is to provide somebody who is not very well off, who only has maybe $50 million, with the same type of support that somebody with $5 billion would have. I'm joking about $50 million, but it's okay to laugh. Only if the jokes are funny. So that's really the concept. That's what we have to offer in the marketplace, is to be an outsourced family office. Rather than trying to build your own family office, you come to Choate and receive that same experience. And there's a very large market for this. In the United States, over finding is that others who recently, been able to amass a significant level of wealth are facing the same kind of challenges. And that's why I'm excited to talk to you and other audiences about this idea, because I think it's very relevant anywhere that large amounts of wealth is being generated. Oh, okay. That's great. Okay. So let me switch gears and talk a little bit about how we invest. So when you and I, as I said, are responsible for the investment management portion of the family office. And so what are we concerned about there? Well, there's really two things that matter to all investors, and that's risk and return. And so that's really where we start. In terms of return, this is a chart that's probably familiar to many of you who have investment experience. This is a timeline that starts in 2006 and goes through this year. And what we've done is we've rank ordered and color coded different types of investments. The highest returning asset class of that year is on the top, and the lowest return is on the bottom. And it's very clear to see the pattern, right? No, there's no pattern. And so this is really our palette. These are the tools that we have to use as investors to build a diversified portfolio. And for us, the variability of these asset classes really underscores the need for a disciplined approach. So one thing I wanted to talk to you about is how do we organize kind of what looks like a very chaotic market for our clients and find opportunities. In any given year, there are massive differentials between these various asset classes. We start from a global perspective, which is a little bit unique in the United States. Most investors around the world, particularly in the U.S., have a strong home bias. They tend to have much more of their portfolios invested in the domestic market than they do overseas. We take a neutral approach from a market cap perspective. What that means is our baseline equity allocation is about half in the United States, because about half of the world's market cap is American companies, and about half is outside the United States. Now, you might argue that that's actually a home bias of its own, because from a GDP perspective, the U.S. is not half of the world, it's about a quarter of the world. And my thesis is that over time, the world's market capitalization is going to look more like the chart that you see here, which is a chart of global GDP. And obviously, China is the world's second largest economy today and one of the fastest growing. So all investors need to be sure that they're exposed to the opportunities around the world, and particularly the opportunities in Asia, just given the size of those economies. The other reason that it's important to be global is that we just don't expect as much from the U.S. stock market going forward. So when we talk to our clients about the types of returns that they can expect, this is actually the chart that we show them. And what you see in the upper left-hand corner are the annual returns of the S&P 500 over different periods of time. So the 90s were great. In the 90s, the S&P was compounding at an annual rate of above 50% per year. The first decade of the 2000s, you gave it all back, right? There was virtually no return. And then recently, the S&P has had quite a strong return. Our projection, which is going to be wrong, but we think directionally correct, is that returns are going to be somewhere in the middle over the next 10 years. That we're not going to see the kind of high returns that we saw in the 90s or in this decade. We're going to see more like a 6% annual return from the S&P. Now, we're not unique in saying this. So you can see our projection. Is that a later on? Oh, wow. This is great. So you can see Choate's projection here, and we're actually quite in line with a number of other firms that we respect. There obviously are some outliers. GMO has been predicting the end of the world for some time. They'll eventually be right, but so is a broken clock twice a day. And one of the reasons, or a fundamental reason that we believe returns are going to be more modest, is the increase in stock valuation. There's no markets that are particularly cheap at the moment, but the U.S. market is actually quite expensive. Now, the same holds true of bonds. And bonds are actually a somewhat deceptive asset class, because for a long time, bonds have offered fantastic returns. We've had a 30-year bull market in bonds. And the reason we've had it is because interest rates have basically been falling over most of that period. If I was to draw this bottom chart back into the the late 1970s, you'd see interest rates much higher and a steady progression of interest rates coming down. That fueled really attractive returns in bonds. In our view, and again, we're not unique in this, is that bond returns going forward are going to be much more high. And so as an asset manager, I can't rely on my traditional U.S. home buys. I can't simply construct a portfolio of U.S. stocks and bonds and expect to have a satisfactory return. And so that really drives our global perspective, and that's a challenge, I think, for all of us as investors that we have to address. And so a lot of our process is built to address that challenge. The other dimension that we care about as investors is risk. And this is something that we spend a lot of time with our clients, because if we have too much risk in a portfolio, we can turn a temporary loss of capital into a permanent. That might be the moment when the market is down. We saw this happen to many people in 2008. But the client just can't bear the losses and they need to sell. And that's, I think, the worst thing you can do as an investment advisor is expose the client to more risk than they can bear. So we spend a lot of time with our clients really getting to know them so that we're giving them a proper level of risk. If you take too little risk, however, you're going to be money on the table. And so this is one chart that we use to educate about what risk really means. And what we have here on the left-hand side are the odds on a rolling 12-month period of a 10% loss, which most people would consider to be a big loss. You feel that, you notice that in the portfolio. And what we say is, by the time you get to a 100% stock portfolio, that risk is over 10%. That's basically, it's going to happen. That's business as usual. You should expect, if you have an aggressive portfolio, to occasionally suffer a 10% loss. And in terms of a worst case scenario, well, 2008 offers us an example of that. An all stock portfolio from peak to trough is down 50%. So the losses can be quite staggering. And you do not want at that moment to have to sell. And so we want to be sure that we're putting capital at risk only to the extent that we can bear those kinds of losses. And so many of you are doubtless familiar with this. If I was to simplify my job into one picture, this would be the picture. We have two things to manage. We have risk and we have return. Now, the best place to be in this graph is obviously right up here in the upper left-hand corner. My personal name for that is the Bernie Madoff corner. I finally got you to laugh. That's great. Because that's what he was promising. He was promising very steady 1% of lunch type return. Obviously, unless you're running a Ponzi scheme, that's not sustainable. But the worst place to be in this chart is down here. You could call this the pets.com corner, where you're taking a lot of risk and you're generating no return. And so our challenge as investors is to optimize the portfolio, basically create as efficient a portfolio as possible. The first step is to decide where the client belongs on this risk spectrum. Can they take a lot of risk out here, or should they be very defensive here? And then we need to maximize the return for the client. And the way you do that is through a disciplined, diversified portfolio. I like to joke with people when you talk about, I like to do these crazy athletic things. Investing is just like being an athlete. There's no secret, right? If you want to be in shape, you should eat well, you should exercise regularly, and you should get enough sleep. It's not a secret. Everybody knows this. Walk down the street in America and see how many people are actually following those three simple things. Not as many as should. It's not a secret. It's just really hard to do. It requires discipline. It requires daily focus. And that's a big part of what we as investment managers bring. So we're basically glorified personal trainers for our clients. Now, there's a joke that my Oxford tutor used to like to tell me that an economist is somebody who sees something working in practice and wonders if it works in theory. But this theory of the efficient frontier has actually been borne out in practice. And we see that in this graph. So what this shows you is over different time periods, what has the return look like for different combinations of stocks and bonds? So on the far left-hand dot would be an all bond portfolio, and the far right-hand dot would be an all stock portfolio. And then we see different combinations in the middle. And what you see is this notion of this efficient trade-off is borne out by the market. Now, occasionally, like in the early parts of the 2000s, you see actually a declining risk premium. You're punished for taking risk. That is the exception. It does happen. It's important for clients to understand that it happens. But most of the time, we see this type of upwardly sloping frontier. And now, what the clients can achieve in any period will be dictated by what the market brings. You know, during the 2011 to 2015 period, the frontier was much lower than it was back in the roaring 80s and 90s. And that's just simply a function of how markets are valued. So that is our challenge. How do we do that? How do we structure portfolios? Well, to greatly oversimplify, we think of ourselves as having 4 broad types of tools to build a portfolio. There are very safe assets. We label them as defense, typically cash and bonds. Very simple, straightforward investments that will not lose a lot of money. In fact, will tend to gain in a crisis. And for a defensive portfolio, that's most of what you will own in a conservative portfolio. We think, however, in this environment, it's a mistake to ever have an all-bond portfolio. An all-bond portfolio just simply doesn't protect you from some important risks that exist in the market. It doesn't protect you from inflation, doesn't protect you from rising interest rates, doesn't protect you from a falling dollar. And all those things probably going to happen. And so even for our most conservative clients, we tend to build a portfolio that includes these other elements. Higher income producing bonds. So this is where you're either taking credit risk or duration risk in the portfolio, or you're lending money to people who might not pay you back, or you're lending money for a really long time. This is what that means. It's riskier, but it also brings a higher return. Many U.S. investment managers, especially those who sort of politicize their investments, got very worried about inflation after the crisis. They thought the Federal Reserve was printing too much money. That was inevitably going to be inflationary. And one big mistake that a lot of investors have made is over-insuring their portfolios against inflation risk. You can see from this diagram that we do not share that view. Very little of our portfolios are dedicated to inflation. We think actually deflation is a much bigger risk than inflation. But nonetheless, we do consider that to be a dedicated asset class because it has some unique characteristics. We just don't use it very much in our portfolio at the moment. And then finally, as you make a portfolio more aggressive, you see this portfolio turns almost entirely blue. Those are stocks. And so for growth, for long-term return, equities are still very hard to beat. And Warren Buffett famously bet after the financial crisis that a simple S&P 500 index fund would do far better than any hedge fund, and he's been proven exactly right. So there's a lot of engineering, there's a lot of complexity, but some very simple tools in the equity space can be quite useful. And you can see we use a mix of those in our portfolio. This is a diagram of our investment process. I think this is basically how any investor should approach investing. This is how most institutional investors in the U.S. approach it. And this is really the discipline that we follow. And you'll notice step 1 is risk. Step 1 is deciding how much risk is right for my client. Getting back to this axis, I need to be sure I position my client appropriately with a level of risk. If they should be here and I put them here, none of the other decisions I made actually matter. After that, what we do is we structure what we call a strategic portfolio for the client. And the concept behind that is this is a long-term portfolio that we would be very happy to hold for an extended period of time. This is our default. This represents the way we would take this risk over time. And the nice thing about a portfolio like this is it takes away a lot of what I think I know about the future. It doesn't matter what I think the next tweet is going to be. It doesn't matter, what I think is going to happen in the Middle East or Saudi Arabia. I'm just going to structure the strategic portfolio to review. Yeah. Please.
Okay. So when do you decide to change that? Annually, or you set your long-term strategic allocation.
Right.
You have in mind, but things change.
That's right.
So how does that evolve? Is it an annual process?
Yeah, it's a great question. It basically evolved. We meet on a regular, we meet weekly, twice weekly about our investments. And what you see is over time, a theme may be emerging that deserves its own dedicated allocation. And that will make its way into a strategic allocation. So for example, we've become convinced that climate change should be a part of all of our portfolios, not just the ones that are dedicated to socially responsible investing. And And so we have a dedicated portion of opportunistic investment where we're investing in things like water scarcity. And that's an evolution of that structure. But typically that takes place slowly. Commodities have gone from being a strategic asset class for us to disappearing. But the structure looks essentially like it did 10 years ago, just because we want to maintain the discipline. The way that we adapt to the market is more the third step of tactical asset allocation, which is within the ranges that we've established for ourselves. Do we want to be underweight at the moment, or do we want to be over?
So what's the timing? Is that things tactical? Sometimes it's every month, and sometimes it's every 6 months, and sometimes it's every 2 years.
That's right. It depends on what's happening in the market. Yeah, that's right. Yeah. Yes.
What question on the strategic asset allocation? When you make the strategic asset allocation, do you have assumption that what is the asset is basically?
Yeah. It's challenging, and we do it with a lot of humility. The best guide to the future in investing is the past. And so we take as long a data set as we can for different markets and use that as our baseline assumption. And then from there, we look at valuation. And so the way that we define future returns is based on a combination of historic returns and current valuation levels. And we're basically weighting the two depending on how extreme they are relative to their history. So it's not a precise art, and we recognize that in our process, but directionally we think that it provides us with a more control.
The final step in our process is to decide how we're actually going to invest, selecting the underlying investments. And that's where being independent is very important, but I think actually being independent is more important for step number one. And this is something that a lot of investors don't appreciate. It's one thing to have the freedom to say, you know, I don't think an actively managed U.S. stock fund is going to do well, let's just own an index fund. And we do that. But the bigger decision is to say, how much of your portfolio ought to be in stocks? How much should be in bonds? And if I have a business model which is based on commissions, my goal is to make the portfolio as risky as possible, because those investments pay me more, right? The more I can put exotic investments into a client's portfolio, higher risk investments, the higher my commissions are going to be. We are very glad we don't have that business model. We're glad to be completely independent. We are indifferent as to whether our client pursues a very conservative strategy or a very risky strategy or something in the middle. And unfortunately, in the United States, we are still in the minority in terms of our business model. Most advisors are really sales. They're trying to persuade a client to invest in a certain way because that will be better for them. It may also be better for the client, that'd be great, but that's kind of a secondary consideration. So the way that this process manifests itself is through a picture like this. And this looks very strange at first, but let me describe what you're seeing here. This is an example of an actual client's investment portfolio strategy. So this is the way we would define an investment policy for a client. The first thing to look at is this horizontal axis, which is, again, the axis of risk. So our most defensive investments are here, our highest growth, most speculative investments are here, and there's a sort of a spectrum across the bottom. For each one of these asset classes, such as U.S. bonds, we've defined a range of a low and a high, which are denoted by these rectangles. And basically, the policy will, the investment policy will keep us within those ranges for this particular client. So for this client, we're always going to have between, say, 4% and 20% in U.S. bonds. At the moment, we're actually quite underweight bonds. We have a 5.3% weight. And that reflects our view that bond returns can be relatively modest, given the health of the economy. We're comfortable taking more risk in higher risk bonds. And so you see there's high allocations to some of the more opportunistic investments. And so when we meet with a client, we spend a lot of time looking at a picture like this, helping them understand all the different allocation decisions that we make. There's a lot of information summarized on this one page. The last step in our process is decide how to invest, to decide what, how are we going to actually invest in an opportunity for our client. We've decided the level of risk. We've decided how to allocate that risk on a strategic level. We've made our capital choices. And now we actually need to invest. And this is our process. It's very similar to the broader process that I told you. We start with the first fundamental question of, do we think this market is efficient or not? And we start from the hypothesis that most markets are pretty efficient. They're pretty difficult to beat. So again, not being embarrassed on an index fund, not having a disincentive from opening this index fund is a huge benefit to us and a great source of freedom. Increasingly, we are using a combination of active funds, passive funds, and hybrids, and I'll talk about that in a minute. Where we decide active management is appropriate, we then do some quantitative screens to narrow the universe, and then a more qualitative deep dive. And the question that we really ask in terms of our qualitative evaluation is, can this be replicated? Do they have a process that we think is sustainable? It's the same question we think our clients should be asking us. It's, okay, we performed well in the past, but how do I know that this is going to continue? And the only way you know is if you can be convinced that there's a process, there's a methodology, there's a we're eating right, we're sleeping well, we're getting our exercise, we're doing it daily. And that is how we approach portfolio management. So as I mentioned, the menu of choices that we have, and I think most investors have in terms of how they actually invest, how do you express a view, really boils down to 3 different categories of investment. And to simplify, we think of that as being passive. This essentially is a market cap-based index, like an S&P 500 index fund. There's active managers, somebody in an office picking and choosing stocks, deciding whether IBM is a better stock than Microsoft. And then increasingly, there's been development of what's been called smart beta. I really don't like this term, but it's the sort of term of art in the industry. I think of this more as being an index with an attitude. This is an index that's based around something other than simply market capitalization. It might be selecting stocks based on their volatility. It might be selecting stocks based on valuation. It might be simply equally weighting constituent parts of the index. But more and more, we think that this is quite a powerful way to invest. In fact, some of the active managers who are most successful really are closet smart beta investors. They're simply following a discipline of always buying cheap stocks or always buying low volatility stocks. And that's worked out for them over time. But if you compare them to an index that does the same thing, suddenly all their outperformance goes away. Why overpay for that if you can get it through a simple sort of smart beta type approach? Yes?
I'd like to ask a quick question. Just smart beta, can you mention what that is? Or
Yeah, it's a terrible term. It doesn't really mean anything. But the way what it's supposed to mean is in investing, there's a concept of beta and alpha. And so beta is what you get from the market. If I own an S&P 500 index fund and it goes up, 20% like the S&P has this year, that's the beta of the S&P 500. I haven't gotten anything extra. I've just gotten what the market has given me. Alpha is the term for anything above and beyond what the market delivers. So the notion of smart beta is a smarter way to expose yourself to the beta of the market. I'm not owning the entire market by market cap. I'm owning a part of the market that I think is most attractive and I most want. Does that make sense?
Yeah, I need to keep studying it.
All right. One of the reasons that we're not embarrassed about owning index funds is that they do really well. It's really hard to beat the market, and that's really the point of this graph. This shows you the percent of active managers who did better than the market over the past 5 years in different categories. So the record of U.S. small cap in particular is quite abysmal. Only 6.2% of active managers did better than the market. That's less than you would expect by random chance. Right, so if we replace all of these guys in their nice suits and their offices and their, whatever they do, with monkeys throwing darts, this number would be higher. Well, that's kind of remarkable. This is a whole industry that's destroying value, basically. Now, internationally, there is a greater success rate, and so we are more open to the idea of active management when it comes to international. We've got about a 1 in 4 chance of doing better than the market. Still very tough odds. Still a very difficult thing to do, but nonetheless, it's an area that we can work on. So when you look at our portfolios from a what do we own perspective, this is how they break down. About 30% of a typical client's portfolio will be in passive market cap index funds. Another 20% will be in these smart beta type positions. emphasizing low volatility, emphasizing specific sectors like healthcare, equally weighting stocks. And then about half will be in active management. So again, we like active management where we can add value. It's just important to be skeptical about how much value active.
So what is the, what do you see value of active management?
I think where the market is not efficient, it's important to work with an active manager. And the market can be inefficient for several reasons. One is it can just be really hard to trade, like frontier market equities. Very difficult to buy stocks in Argentina and Kuwait and Saudi Arabia. And so an active manager that knows those markets, knows the liquidity, can add a lot of value simply through market access. Another is market knowledge. You actually know something about the market that isn't already priced in. In the U.S., there's a lot of information available. The market quickly absorbs that information. It's very hard for me to know something about Google or Microsoft that the world doesn't already know. It's a little easier to know something about a emerging market small cap stock, for example, that other people don't know. And so we think in different markets, an active manager might be able to have a sustainable advantage through their analysis.
In other words, in the U.S. equity market, the value add by active manager is quite little.
Yes,
Because of
that's right. Exactly right. And many active managers have been humbled by that over the years, including the entire hedge fund industry over the past 5 years. And when I say we, I really mean when you have developed some very interesting quantitative tools. We're very fortunate to work with some very bright members of our team. I always like to say the younger the team, the higher the IQ. We've invested a lot in our quantitative ability. And so this is an example of a quantitative tool that we developed in-house to help us navigate the market. It starts with a number of weekly data points that we think are informative to risk. We've listed them here, things like credit spreads, the VIX, the put-call ratio, the yield curve slope. From this mess, you can derive a signal. And from that signal, you can look at different market regimes. And so, again, this isn't the only tool that we use, but this is one that helps us to think about, do we believe that volatility is going to be high or low in the market? And one of this has been reassuring to clients, because if you look at the headlines in the United States, you probably wouldn't invest at all. But looking through that to the underlying data, the market is actually telegraphing we're in a relatively low volatility regime. We expect markets to be relatively calm. And so, in fact, this indicator has recently become even more positive over time, and that's given us the courage to stay with our striking underweight bonds with some of the investments we made in higher risk equities. We also have valuation analysis plays an important role. This is an idea that we put into effect at the beginning of the year when we looked at healthcare valuation and really separated from the market in a meaningful way. And so this is an example of one of these tactical opportunities that comes with the market. It's, we've actually begun to reduce this position because this gap that we saw has started to close. But when you see these sort of valuation gaps open up, that's an opportunity to make a tactical decision in a certain sector. And we've been doing some very advanced work with machine learning as a part of our process. This is a tool that Wendy again has been developing for us. I just like the name, the random forest. I have no idea how it works, but I'm very excited about it. And if you'd like to ask questions about it, you can ask them. But one phenomenon that we see in our business is the rise of quantitative analysis. I think the strongest investment managers are going to have a sort of duality, a blend between fundamental perspective and a quantitative perspective. And we find the quantitative perspective is a very tough sparring partner for us when we're making investment decisions. And we love the rigor that it brings to our process. So we've been early adopters, we've been big believers in this, and we think that this is eventually going to be quite central to all successful investment management. More on the themes that we're excited about, and then I would be glad to take questions. One of the things that we think is increasingly important, the market is not cheap anywhere, so it's very important to have high conviction in what you're investing in. You don't have sort of margin of safety, you just cheap markets and a tailwind evaluation. That's particularly true in the United States, as I mentioned. And so we have become more and more targeted and thematic in the way that we're investing. These four themes to us are very important. We think these are going to shape the markets for some time. One key theme is the rise of the Asian middle class, particularly in China and India. That is an enormously positive trend as people rise out of poverty and are able to consume and enjoy. There are tremendous economic opportunities that come from that, and we're investing in those in a variety of different ways. Looking from targeting specific high growth companies to looking actually at Japan as a very interesting market with hedging on the risk. A second theme that we're excited about is really being targeted within the U.S. market. I mentioned healthcare, something that we identified with our quantitative process. We've had actually a large position in U.S. internet companies as well. Obviously, that's worked out quite well so far this year. And part of that is just the thesis that we're in an environment where those companies have wide modes of sustainable advantage, and it doesn't look like from a regulatory perspective that a monopoly is going to be challenged anytime. I briefly alluded to water earlier. We have a broader theme of changing climate, and water scarcity is going to be an aspect of that. So water has actually been, other than the internet companies, one of the best performing investments in our portfolio so far. And we also have been focused on higher credit risk. And there we're taking a kind of unique approach to focus on higher credit risk within the household sector. If you think about taking credit risk, you can lend money to risky governments. You can lend money to Zimbabwe or Venezuela if you like. Good luck. You can lend money to risky companies that may or may not pay you back, or you can lend money to individuals. Of those three sectors, it's actually in the United States, the household sector, which is in the best financial shape. The household sector has spent the last 10 years paying down debts, reorganizing themselves. Their homes have improved in value. Their unemployment rate has gone down to below 5%. So this is, we think, a good market, and there are some interesting sort of mortgage-backed securities that we've been investing in to take advantage of that. Asia remains quite a theme that we're most excited about. This is a chart that may not be surprising to anybody in this room, but is quite surprising to our clients. It's the simplest way we found to just convey that doesn't need to pay attention. More people live inside that circle than live outside of it. And where the people are is where the economy is going to go. And so it would be negligent for any of us who are in charge with investing money on behalf of clients and neglect this part of the world. And as I mentioned, the rise of the middle class, which really is a story mostly about India and China, is something that we find very exciting. The difference in your life between living on $1,000 a year versus $10,000 a year is utterly transformative in every respect: diet, transportation, education, healthcare, banking, you name it. And that really is a tremendous opportunity. China's had very impressive, as I'm sure you're all aware, growth in household income, far outstripping the developed markets from 2007 to 2016. And we don't see any signs of that slowing down. This chart is a favorite of our clients in Boston. I dug up a map of the Boston metro system from 1973, and you can pretty much use it today if you wanted to. Here we are in 2017. It's a little different. There are a few more stops, but basically we're looking at the same infrastructure. Rio de Janeiro's done a little bit better, but same basic outline. Here's that green line, a few more stops. Here's the orange line. There's one new line, a couple of extensions. Shanghai, yeah, totally different story. No subway system in 1993, and today there are 16 subway lines. So truly remarkable. And the headline here that you see is, we think that the electric car is coming bigger, faster, sooner than most, at least Americans, expect, and that change is really going to be driven by China. has all kinds of implications. But anyone who sort of doubts, well, the infrastructure involved is very difficult to build, well, they aren't really paying attention. And still, despite the enormous progress that many Asian economies have made, they still have a lot more room to run. This is a chart in blue of the trajectory of the United States over time on a GDP per capita basis, normalized for current dollars. And so it stops in 2010, but by 2010, US GDP per capita was about $30,000, roughly in line with where Hong Kong and Singapore are today. Taiwan and South Korea aren't too far behind. They're about where the US was in the 80s. And China, Thailand, and Malaysia are where the US was in the 1950s. It's a lot easier to go from here to here than it is to go from here to here. You have to invent brand new things. Your government has to be even better. Your infrastructure has to be even better. Not obvious that that's happening in the United States. But the roadmap is there for these economies. And we're particularly excited about this middle group here, which have already achieved a tremendous amount of growth, but still have a lot of economic potential. I'm going to skip over that just in the interest of time. Water scarcity. This is one of the last themes that I'll talk to you about. Here's how much water we have in the world, and here's how much we're going to need by 2030. So we have a problem. And on top of that, we have aging infrastructure in the United States. You may have heard about Flint, Michigan. That is not an anomaly. That is not going to be unusual. Unfortunately, most of our water infrastructure in the U.S. is old. Most of it was built about 40 or 50 years ago. We started out in the suburbs. And there is a massive opportunity for companies that are going to actually address that aging infrastructure. And that's an area that we've been investing in. And then finally, related to water is our overall focus on climate change. We have clients, increasingly younger clients, who are very socially conscious and want to be sure that they feel good about their investments, that their investments are aligned with their beliefs. But there are certain areas where we just think all investors need to pay attention. And the theme for us is climate change. And so we are increasingly moving our portfolios from this traditional model into a model which focuses on climate change. Things like reducing our fossil fuel exposure, we think is just good investment practice. I hope you found this interesting. I'd be glad to answer some questions. So thank you for your time.
Yeah, my question is about your business side. So you said you have about 77 employees.
Yeah.
So I'm curious, how many clients do you have, and how big is your asset under management, and what is your criteria to choose client? And do you pick client who is not your citizen and don't have income? I'm talking about Israel.
Yes.
I network family from China.
Yes. So we have clients who are not U.S. citizens. We work with clients in Latin America. We work with clients in Europe. We work with clients in the Middle East. We don't actually have any clients from Asia. We have clients all over the United States. We consider ourselves to be a global investment manager that happens to work in Boston. And we would be delighted to work with clients from China. In terms of assets, we have about $5 billion of assets under management. And our minimum client size for a new relationship is $10 million. Typically, that would only be somebody whose wealth is rising rather quickly, because, and it's not because we don't think that $9 million is not a lot of money. It's just we have to have a help somewhere, and really to take advantage of all the services we offer and the complexity of our portfolios, you really need that sort of critical mass in the portfolio. So that's the kind of business we have. We have about 400 clients. About 100 of those are sort of what we consider to be ultra wealthy people with an average net worth of around $100 million. We don't manage all of their money for them, but we manage a significant portion in most cases, and then we're involved in monitoring the other assets. Yes.
So I noticed that your firm actually is a member of the BCIC.
Yes.
So if you can talk about how, for those who don't know, that's the Sustainable and Responsible Investment, near to my heart. So what's the kind of adoption of the ESG or SRR investment in your client base? And what are some of the conversations that you have when you sit down with clients, especially in the framework of risk and return framework?
Right.
And how do you incorporate that in your process?
It's, in terms of the interest in sustainable investment is a small part of what we do, but it's growing very fast. And so a few years ago, it was a very small part. Now it's 10 to 15% of our clients have a fully sort of sustainable ESG portfolio. But all of our clients are invested in sustainability themes because we just think they're good investments. And so we're not doing that because they told us that from a morality perspective or a values perspective, they want to propose a certain way. We just think water is good investment. We think that other types of clean technology may be good investment. Those are coming into our portfolios now. So I would say it's a very rapidly growing area. And things like the confluence of all the hurricanes and forest fires and other natural disasters that we have recently in America help focus a lot of attention on this. I think Donald Trump actually is going to win the Nobel Prize because he has unified the world, on climate change. He's unified the world in terms of free trade. And unfortunately, we're not unified with them, but that's great. If you said, guess what? In 2017, name the country that will be the world champion of environmental responsibility and free trade. I'm not sure China was in my top pick, but I have to say, I think it's a good candidate. So there's been a lot of focus, actually, ironically, because of the backlash around the Paris Accord and that sort of thing. Clients have been energized by the result of the election. Boston tends to be a fairly liberal city, and so more people are asking us about sustainability for a variety of reasons. Yes?
With the stock market record high almost every day, and also the economy has been expanding 10 years since 2008. Among all the asset classes, different classes of assets, what are the top three you think is representing the best investment opportunity now from market?
It's a great question. Really will be represented by this list of thematic investments. So this is where we think the best opportunities are. I would highlight Asia. Emerging markets have had a sustained period of underperformance. Valuations are still quite reasonable. And despite the fact that there's been a very strong run this year, we think that has further to go. So that would be number one. I think there are still pockets in the U.S. where you want to be allocated. And then there are some thematic investments around a changing climate that people are excited about. This is our top list. Yeah.
So regarding international clients, so they have a less favorable tax treatment. So how do you handle that strategy?
Well, that's where our legal and tax expertise really comes into play. Acting as that international tax office. One area that we have particular expertise is international tax and estate planning. Just because if you're a lawyer that practices in the field of these fields, typically that's not a part of what a major law firm would do. That's typically a small practice. At Show, we are actually the largest practice of our firm. And so some of the most talented lawyers gravitate to that area. I'm the wrong person to ask about the specifics because that's not what I do. I'm more focused on investments, but I know we have a lot of expertise in that area. And we work with a number of clients to help them with tax management.
Yeah, that's my question because we have to pay 30% a tax for any capital gain, not like U.S. resident.
Mm-hmm.
So that will reduce your return. I mean, what's your strategy? Just use a less tax-sensible investment, or is some other strategy?
Well, it's interesting. It's a lot of it, and this is something. Thank you for the question. A lot of our clients are taxable individuals in the U.S. Although they have a low rate, they're very tax sensitive too. So our entire practice really is built around after-tax returns and maximizing that for clients. And many investment managers, if that's kind of an afterthought, they take more of an institutional mindset where they're used to trading for a nonprofit or an IRA where capital gains taxes really don't matter. So in all of our investment decisions, we take capital gains is an explicit capital gains budget. So a level of capital gains is acceptable to the client in order to try to stay below so that nobody gets surprised in terms of the capital gains liability. Yeah.
I have two questions. The first question is piggyback on the question raised earlier about the economic cycle, especially because the international equity has outperformed the United States equity so far this year.
Right.
But as you look at US, interest rates continue to be low, and business cycle still seems to be the mid to late. And so, do you believe that next year international equity, especially emerging markets, will continue to outperform the US equity? That's one.
I think there's a good chance of that, yes, yeah, please.
And two is, how do you construct a benchmark? So if you have, let's say, 60-40 split for clients, how do you do a benchmark from there? And so do you get your alpha from your vehicle positioning and your tactical allocation process? How do you do that?
That's right. So in terms of the benchmark, we think of our stock benchmark as being the MSCI All Country World Index, which basically represents the market capitalization of the world. So about 53% of that is U.S. companies, 11% is the emerging markets, and the rest is the developed.
That's what equity.
That's for equity. And then for bonds, typically we're using U.S. bonds for safety. And so our benchmark for 60-40 would be 60% MSCI Country World Index, 4%.
And then your alpha will come from.
Sorry, I'm dating myself. And my alpha would come from vehicle selection, pursuing targeted means, being correct about tactical positioning. Yeah.
I have a question about the asset allocation. You talk a lot about the allocation among the traditional asset class. And how about those like, I know most of those clients are high net worth. How about their appetite for the like hedge fund strategy? At least their strategy.
Right.
Private equity.
Yeah, I think those are important categories, but very different. We actually think that there is alpha in private equity. We are actually in the process of launching a private equity fund of our own, but we help our clients for an extended period to evaluate private equity investments. And we've had so much demand for our own fund that we're doing that at no additional fee. We're just basically systematizing the funds that we selected and putting into a portfolio that our clients. Hedge funds were very skeptical. We think that most hedge funds, fees are too high. There really isn't a sustainable source of outperformance. And we're just very skeptical that hedge funds actually have value in the portfolio, so we simply decided not to. We think of a simple low volatility stock fund as being very good hedge fund substitute, actually. And so one of the ways that we have hedge fund-like exposure in our portfolio is simply to invest in funds that systematically select for less volatile stock. And the performance of those has actually been far superior to a hedge fund index. The killer for hedge funds, we think, is just the high fee. Returns are uncertain, fees are certain. And lately, investors got fees and not nothing.
Okay, on that, business model-wise, what's your fee on service charge at the asset?
So we charge a fee on the assets that we manage, and it's a sliding scale. So it basically starts at 1.25% on the first few $1 million and goes down as the assets increase. And the last rate point is above $50 million, our fee is 0.5%. So it gives you a sense of how the fee declines as the assets rise. And that's fairly typical. That's what we would typically see for a company like ours. We are not cheap, though. Our fees tend to be a little higher than most, just because we offer a premium. Yes.
Continue on the question, you're talking about the sample concept. Are you totally avoid fossil-based energy?
Not yet, but we're getting there. We have far less fossil fuel exposure in our portfolio than you would see in the benchmark. We're not completely out of fossil fuels, but that's the direction that we're going. We think that, yes. think that in the short term, there's a possibility that oil prices might rise just because of production constraints, conflicts. You know, it's unclear what Mohammed bin Salman were doing. I'm not sure it's clear to him. And so we want to be careful. But in the long term, we're convinced that the world is shifting away from fossil energy, and so we want to be on the right side of that.
So you have to take as an investment over exit, and that's obviously true for the year. Mainly because the stock market has been doing well, it's easy to invest.
Right.
But what if all that dynamic shifts on the next economic downturn? For example, another 2008 happens, and all your portfolio investors are found negative when they all how do you protect?
Right, well, the first thing you do is make sure that the client is taking the right amount of risk. That's the best protection, so that they aren't overexposed to equity risk in the first place. The second is, looking for opportunities to mitigate that downside. So we do use a fair amount of active management. More than half of the typical portfolio is actively managed. That tends to be in the international stocks, and we look for managers that have a good downside capture ratio. They've been tested in previous downturns that have shown that they can preserve value. And then in areas like the U.S. where we think the market is more efficient, one thing that I didn't talk about is actually moving to more of an equal weighted approach, where you're not buying stocks based on their market capitalization. If you think about that, you're always buying high and you're always selling low. And if a stock goes up, you buy more of it in the market cap index. If it goes down, you sell less of it. And that's really the opposite of what you typically expect. That can work in markets that have a lot of momentum, like the market going down. But in a correction, we think that an equal weight portfolio will actually never downside capture. And then you use some of these hedge fund proxies, like we were talking about earlier, like low volatility funds, which we believe in the past have shown much better downside capture. So there's a variety of ways that we mitigate it, but the first and foremost and most important is just making sure your clients are taking capture risk to begin with. Yes.
How do you deal with the currency?
It's a great question. I don't think that we or almost anybody else can really predict currency, and over time, currency tends to revert to a mean. So we just accept it for the most part as part of the return dynamics in the portfolio. For example, this year, if there was one thing that everybody knew at the start of this year, everybody knew, and we surveyed all of our managers, they all knew this, the dollar was going to go up. No question. Like, that was going to happen, absolutely. Clear, obvious. The Fed was going to be raising rates, the rest of the world was holding rates constant. Totally for sure the dollar was going up. What happened? The dollar's gone down a lot this year. And that's been part of the reason that international stocks have done so well. It's because when you translate those overseas profits into dollars, the effect is magnified. So we think that currency can work for you or against you as part of the diversification benefit of international stocks. But in the case of the yen, we have an opinion. We might be wrong, but if there's one central bank that seems very clear on holding interest rates down while the rest of the world interest rates rise, there's one country that has wallowed in deflation for decades, it's Japan, and they're tired. And with Abe's re-election, it seems that there's a mandate to continue this Abenomics program. So we think that that's going to cause downward pressure on the yen. We think that's going to be good for Japanese stocks. And so getting back to your question about what we like now, dollar hedged Japanese stocks are one of our themes. No, the hedging that's done in that particular investment happens at the fund level. We don't do currency hedging ourselves, again, because we don't think we have insight beyond this sort of macro call on the yen to be doing those sorts.
I have a question about passive investment. As you know, like the passive assets has been growing exponentially, and also the products available in passive section also. I think one statistic like we have more.
There are more products than investments. Yes, that's right.
So when you talk about passive investment, are those nuances like nuance differences between products are very important to you, or you feel like it's more like
Oh, it's extremely important to be very skeptical. There's been a lot of gimmicks that have come out. Even the tickers are getting really corny. You know, you can invest in old if you want to invest in OLD is the ticker for companies that play on the theme of an aging population. You can invest in Robo if you want to invest in revised robots. You know, you can invest in Fit if you want to invest in companies that are trying to address the obesity epidemic. So you can fill your portfolio with cool sounding kind of gimmicky things that may or may not work. Robo's actually been quite a good investment this year. But when we think about an index, we want to be sure that it's well diversified, that it's validated by research, and that it's held up over multiple years. And if you think about this smart beta category, there are many, many things that have been hypothesized to drive stocks. There are very few that actually seem to work over time. And it's really a list of 3 or 4. So buying stocks when they're cheap seems to work. If you consistently buy cheap stocks, that tends to work. If you buy really high quality companies, that tends to work. So quality, value, momentum tends to work, actually. If I buy stocks that are rising rapidly, typically that works, at least for a while. And low volatility. If I systematically select for stocks that are low volatility, I'm eliminating the kind of high-flying lottery ticket stocks that tend to blow up most spectacularly. So if you do those methodologies consistently, you go through these kinds of indices, that actually works. Beyond that, it's very difficult. So I advise a high degree of skepticism, especially for somebody, and I would never, ever, ever buy a leveraged fund. So you get these funds that say, we'll give you 3x the market return or 3x the downside. Those are terrible. Do not buy them. They don't work. I think it's equally terrible. I would avoid it. All right, that. So private equity, we are looking mostly for proven fund managers that have a strong track record, that operate in the space where we think they can continue to make money. One of the biggest criteria for us in private equity is just the market that they're operating in, whether we think valuations are appropriate in that market, and also their size. And one thing that we like to say is capital kills return in private equity. So once a private equity fund gets too big, they're more concerned about the two, the fee they're charging on the assets and the 20, the fees that they earn if they perform. And it becomes more of an asset accumulation vehicle. And that's an improvement empirically. Private equity funds grow above a certain scale. Typically, their outperformance tends to decline. So we're looking for more innovative, newer managers that have a track record that they're still hungry and still, have something to prove in there. But it's very, very challenging. Yeah. Yeah, it's a giant casino. It's a completely a greater tool. So I would, obviously Bitcoin is great. When your mother asks you about Bitcoin, it's time to stop. And that's the state you've gone to. My mom is asking me about Bitcoin, it's time to get out. Just like time to, the kids don't use Facebook anymore because they're on Facebook. And so, these ICOs, it's an innovative, it's basically a way to fund the company without, complying with a lot of regulations. You sell, tokens that may or may be worth something to people in the hopes that maybe they won't. Some of them will work, many of them won't. It's completely a greater tool. We just avoid things like that. So I mean, I'm being a little bit flip. Obviously, we do make a lot of money, but it's just not what we do. Yes, exactly.
Yeah, I have 2 questions. Number one, it would be for founder of things other than being independent, what other competitive advantage does it have compared to other places? And then second question, how do you think Nifty is going to impact this index?
I'm sorry, I didn't get your second question.
Nifty, MIFID, is a new regulation that's year.
Oh, yeah.
How do you think that's going to impact the index?
I think it'll have a lot less impact on independent advisors than it will on the brokerage community. I think, shining some light on some of the practices that we avoided, so we're not worried about it. In terms of the competitive advantage of a family office, so one thing is that you actually build quite a strong relationship with your client. And so part of being disciplined is actually trusting your advisor that, inevitably we're going to be wrong sometimes. There's going to be moments when performance is not good. And if you look at investor behavior, typically they'll invest with someone after they've done really well, and they will abandon them when they do poorly. And so, Peter Lynch is a famous Boston investor who wanted to manage the fund called Magellan Fidelity. Phenomenal investor. Very few investors ever got the returns of Magellan. They never got it. And the reason was, after Magellan had a great year, they bought Magellan. And, Peter Lynch had an off year, they sold. And then they bought it and they sold. And you need somebody to stay with you consistently and trust your judgment through the inevitable ups and downs. And the stronger your relationship with them, the more you build that trust, and the more the investors are able to realize that return. So a huge amount of value that any advisor has is just protecting people from themselves. We are wired as human beings not to be good investors. We're actually wired to be terrible. Because on Serengeti, when we were all trying to survive, it was good to like things that you were familiar with and not like things you weren't familiar with. And it was good to spot patterns even if patterns really didn't exist. It was good to be really confident, even though you shouldn't be as confident as you thought. So all these behavioral errors, which affect investing, are good for our survival, but not great for our return. And so a big part of our job, when you and I are just as human as anybody else, but at least we have an emotional distance, we have a process, we've been through market cycles, and that adds, to the ability to generate return. But a client has to be with you through that process. In the family office, we think it's inherently kind of a more trustworthy environment. We're also, as you can see from my presentation, we're pretty open about how we invest. And there's sort of two schools of thoughts. As an advisor, I can stand up here and say, listen, spend all this time in higher education, what I'm doing, trust me, you need money, it'd be great. Or I can explain how I'm actually doing it. And we've taken the second approach. Many advisors rely on it first, and if that's fine until it doesn't go well. And then you ask yourself, why did I get this kind of money? Why did I get trust? And so, both in our business model and in our investment philosophy, we think we're helping our clients achieve the returns that they can achieve.
Another question about your business model. So you said the family office offers 3 different services: investment, tax, and loss services. Right? But it seems you also said the fee is only based on the size of the portfolio. So does that mean, one, most of the time your employee spend is on investment? Second, for clients only need investment services. For those kind of clients, we should not go to you or not?
The general fee includes general advice on legal and tax. If we do legal work for a client, if we write them a will or we prepare a trust, we would bill by the hour for that. If we prepare tax returns, we would bill for that. So the advice that we're giving is investment management plus an overview of tax and legal advice and strategy. But the actual execution would be additional hourly fee. So that's how we charge for that. Yeah.
2 questions. One is with the proposed tax change, the carried interest that will be treated as capital gain ended from 1 year to 3 years. For your private equity investment, do you see there might be skewed behavior change for your private equity managers? And then the second question is related: is with all those tax changes, what are some big categories within like OSI that may really change your investments?
Yeah, it's interesting. I think the tax bill, from an investment perspective, has a couple of impacts. One is just, it's kind of a referendum on, so what is the nature of our government? Do we truly have a unified government or not? It looks like not. It looks like the answer is no. And so despite the fact that the Republicans nominally control the White House, the House of Representatives, and the Senate, it seems that we're still in an era of divided government. Not so bad, right? Markets can perform well in that type of environment, but any hopes that investors may have initially had about the big infrastructure push, totally dead. Not going to happen at all. Any hope that they had for a fundamental transformation of the tax code, I think is equally dead. think where this tax bill is going to end up, if anything, is just a giant kind of unfunded tax cut. We're just going to make the next recession way worse than it needs to be. The only kind of investment benefit for companies, we think is going to be on small or mid cap companies that can't play the kind of games that large cap nationals can, hiding their intellectual property in Cayman Islands or Ireland. And so we actually don't think that it's going to have nearly the kind of impact that is being promoted, unfortunately. And so we haven't factored that in the major part of our investment. We have a slightly higher weight to small and mid-cap stocks than we otherwise might, just because there may be some ancillary benefit, but that's about all that we've done. And it sort of reinforced our sense of global perspective. I mean, up until recently, clients could sort of push back and say, well, yeah, the U.S. is quite unique, right? We have strong institutions with much better governance. It's natural that I would have much more money than anywhere else. I think that argument is fair.
How about the GPs? Are you worried if the holding period is somewhere between 1 to 3 years? Their behavior might be incentive.
It's possible. Again, it really comes down to knowing those specific investors well, seeing how they perform over cycles. That may affect their behavior, but compared to the other factors we look at, that won't be a big determinant of how we invest.
So in the mass market, we develop so-called mono portfolios, and then we map people into those portfolios.
Right.
Do you guys do that too in the office?
It's important for all clients to have your best ideas. And so if you think about, different levels of risk, we have in mind a strategy of how we would optimally position different levels of risk. But in the family office world, they're always tailoring this to the client. Because inevitably they have legacy positions. They bought you grandma's Exxon $2 a share. And you've got to manage around that. Or they tell you they don't want to share type of company. So yes, we do have opinions about different levels of risk, what we sort of optimal portfolios be, but we didn't have to translate this into client context and rely on it.
The portfolio is truly sort of customized for that individual client. It's different clients will have.
Yeah, I would. The clients will all have thematically very similar portfolios. Like we've invested in water across the vast majority of our country, but there is some customization. Where we do have an opinion about what we would optimally like to own. And I think the small-based approach is that. I think it's actually exactly the way to invest, right? You have an opinion, it's your opinion, and it doesn't matter that my portfolio is the same as yours as long as it represents the best idea. But in our business, there's a lot of customization that happens just because of the particular circumstances of the family.
But as you grow bigger and bigger, as your client base grows, do you think that this approach will continue, or you will also adopt more?
I think we are managing to a strategic kind of, and I think that's scalable. I think the model we have is scalable. Yeah.
Somewhat related to the point of being customized to each customer, I think it's pretty impressive that you actually manage 400 different individual portfolios. I'm just wondering, they probably don't rebalance in the same frequency at the same time, so do the client worry about fairness of cluster, or like would the portfolio compete with each other in terms of position?
When we have a high conviction idea, we can block trade across our client base. We have some portfolio management software and tools that allow us to get our ideas in the portfolios relatively expeditiously. But if we have an idea where the success or failure depends on doing it this week versus next week, or this month versus next month, that's really not the kind of idea that's appropriate for our clients, just given their time horizon. We're looking for ideas that can be validated over a period of at least multiple months, if not years. And so some of the nuances of exactly when the clients got the idea, I'm embarrassed to say sometimes works in their favor, right? The clients who got the water investments a little later did better because water sort of did this. So, we won't always time it exactly right. And I think that works itself out over time.
How would you invest in the electric car market?
I'm not sure. I think it's a hard market to make money in. because I think that any market which has become a strategic national priority is a market where profit is not going to be at the center of the market. And you're going to have all kinds of subsidization, you're going to have all kinds of uneconomic behavior, and ultimately that's going to drive a lot of innovation, but it might not be good for the investor. And so just like I wouldn't invest in solar energy, I think solar energy has a wonderful future. I think it's clear that China in particular has made solar a strategic priority, and that's great for the world. It's not great for an investor in solar company. So I'm very happy that China's innovated so much in solar, but I wouldn't invest. And I think the same is more or less true of the electric car market. And frankly, I don't know enough about the merits of a BYD versus Tesla to be able to say, which is better. Yeah.
Thank you for your presentation. And I just want to say, I represent the startup community. So I learned a great deal tonight, and I'm very thankful. But can you comment on, does Choate, your company, do you invest in, directly invest in VC firms, venture capital, or do you, do you directly invest in commercial enterprise startups and vis-a-vis new companies? Is there a percentage that you allocate or invest?
We have some clients who are very interested in VC and startups, but we don't programmatically as part of our investment. It's just too high risk, and we don't feel like we can invest without it.
So how granular when it comes to your allocation and fund selection? For example, when you decide to overweight or underweight fixed income, would you just generally overweight buy or sell the U.S. ag, or would you differentiate high yield versus IG and yes versus other mass sector level, or how would you decide?
Absolutely. We divide fixed income and equities into what we think of as distinct asset classes. And within fixed income, for example, we think of high yield as a distinct asset class where we're making a decision about investment. Just like we would floating rate loans or emerging market bonds or mortgage-backed securities. And so there's a variety of different tools we have under that broad umbrella. And that's kind of the level of granularity that we look at. We also look at the manager philosophy. So for a client that can't take a lot of risk, we may want to have high yield bonds in the portfolio, but we may want to work with a manager that's much more defensive and careful that avoids the sort of triple C type bond. We may have another client who's very aggressive and where we think we can take that kind of risk, and we may work with a different manager who has a more aggressive
Do you want to take just one or two more questions and we can?
Okay, sure. Yeah, that's great. Yeah.
Question about Fairwise. So for you to recruiting for new talents on the investment side of the firm, what kind of qualifications, experiences you're looking for?
Really looking for more of the personal traits, actually. If you look at our team and read their biography, it's not what we typically expect. We've brought people into the private equity industry, we brought people into hedge funds, we brought one of our colleagues used to be the commissioner of revenue for the state of Massachusetts and the energy company. He also spent a number of years as a banker. So we have a pretty eclectic background. And what I really look for is, first and foremost, intellectual curiosity and drive. And then, looking for somebody who really is focused on sort of the level of client service that we like to deliver. So it's that, if they demonstrated that in different ways, that's fine. But it's really more kind of inherently what kind of person it is. When you and I were joking that one of the things we don't have actually is a lot of people coming in on Monday morning talking about big game or sports, which is typically what happens in the investment firm. We have a lot more women and we have a lot more nerds than most investment firms do. I'm proud of both of that. We're particularly proud of our newer members of the team. When you use an example, she came from State Street, she has a math background, not what you would typically say is central casting for investment management, but just phenomenal smarts and across all of us, and that's kind of person. The last question, yeah.
Thank you for being here and sharing your thoughts. And I guess my question is related to the target investment themes. I noticed there's mortgage-backed securities as a credit for those as one of the themes. So what do you think of the mortgage-backed securities? I mean, like they're more than the traditional bonds and how you mentioned risks and what you see. But
Yeah, we're very interested. I mentioned kind of earlier, if I think about a bond, I think about money. I can lend money to a government, I can lend money to a company, or I can lend money to a household. And mortgage-backed securities are really the vehicle for that, addressing the household sector. And of those three areas, what is the sector that hasn't been borrowing like crazy over the last decade? It's actually household. Households have been doing the opposite. They've been paying down their debt. Meanwhile, companies and governments have been levering up. So we like that sector, and the intrinsics we think are very good at the moment. Unemployment's low, housing values are up, wages are starting to rise. So if I think, can I take a risk with a shaky borrower in the household sector, maybe that's a better risk than the government sector. And so that's something that has driven us to really focus on that. We also just think it's fundamentally mispriced, and it's a smaller kind of nichier market where a firm like us can do better. Then we're not competing against the BlackRocks of the world in that particular market.
Can you quickly show the chart? Just
Oh, yeah.
on the chart.
So
it's really the pre-crisis mortgage that we're focused on because they have very high yields compared to the risks that we're taking.
So you may remember Countrywide, WAMU, issued all these mortgages, people couldn't pay them back, they all blew up. Not all, right? Some are still being paid. And those mortgages, if they've been paid in 2009, 10, 11, 12, 13, 14, 15, 16, they're not subprime. Those are good mortgages. And so those are interesting mortgages that have higher yield, and they're trading actually at a discount because they're mispriced. And one of the things as investors, you kind of have to go where the fear is in the market. And this is still an area that's kind of taken by 2008, and we think there's some interesting opportunities. Well, I really appreciate the opportunity to talk to all of you. I really appreciate you spending your Friday night with me here. So thank you very much.
So honored to have you here, Todd, and thank you very much for taking time out of the Friday night. So I thought learned a lot from this, and I'm sure people also have a very positive learning here. Great. So Todd is also a Forbes columnist, and I took the liberty of printing out some copies of his recent Forbes blog. And there's here also our third quarterly update. If anyone wants to see this one, and sure, Todd will be here for 4 more minutes if you have any questions. And thank you so much for coming.
Good question. Nice. Like when you're speaking, you always have that moment of like, there are questions.
Hi, Todd. Thank you so much for this presentation.
My pleasure.
I'm Anna. I'm from Media.
Oh, hi.
Actually, I work with the same here.
Oh, great.
International flight. Yeah.
Yes.
So I have a question. Is that you have tax services, right? So how is it done? Is it in-house or outside?
Right. So we have some tax advisors in-house, but in terms of tax preparation, we actually work with outside firms.
Oh, okay. So public accounting firms?
Yes. Yeah, typically accounting firms. And so we have, some of our clients have accounting firms that like to work with.
Yeah.
Others don't. And
Like the recommendation because it's trusted.
Okay.
Okay.
Yeah.
Okay. Yeah, so that is kind of referral, right?
Yes. We never have a referral fee involved, just because we want to stay independent. And so we just refer the client to whichever firm we think is the best for them.
Okay. How do you think of deal?
I We haven't done, we don't know you, so it'd be good to.
Oh, I see.
Yeah.
So you haven't dealt with
I'm not sure, to be honest with you, this is not my area, so we very well may know that I'm not the tax person on our team, so I would have to ask them what they think, so my opinion really doesn't matter.
Sure. Well, Video Berkeley is the largest public accounting right behind BCIC.
Okay.
Yeah. So I previously was a futures broker and financial planner, and now I'm in tax. So if you are available any noon, I'd like to have a lunch with you if you are available.
Great. Well, let me talk to my my folks about video and see if we already work with you. But I would love to.
Oh, sure, yeah. So I will write you an email so you can hear.
Yes.
Yeah, and write follow-up questions.
Okay, great.
Thank you so much.
Yeah, my pleasure. Very nice to meet you.
Yeah, me
Thanks
too.
for coming today.
Thank you so much for this.
Hi. Oh, my pleasure. Good.
So you're.
What is it about?
I was wondering if I can have like 30 minutes.
Oh, sure.
Some of your prior experiences, like sort of align with my
Absolutely. Yeah, definitely. Sure. Anything for another garbage graduate? Yeah, nice to meet you. Hi. Oh, okay. Oh, great. Oh, sure. Yes. Okay. Yes. We have focused more in regard to alternative public investments, like high yield bonds. We think of as alternative bonds. We make relatively soft. The only thing we've really done ourselves in private investments has been alternative investments in private equity. And this is this private equity fund of funds. And most of our experience and most of what we do is actually public. And our clients tend to come with private investments. They tend to have a relationship with a private equity manager, and that tends to be we do look at REITs. We haven't been favorable on them recently just because we think interest rates might have been rising and that would be a headwind for real estate. We're also worried about what's happening in the retail sector with just rise of Amazon, and that seems to be really putting pressure on the retail sector. So a lot of commercial property may be less valuable than people think it is. And so we've been generally avoiding that recently. But in the future, we may invest.
Amazon,
Like warehouses, yeah. Right. Okay.
Maybe I'll email you.
Oh, great. Yeah, that'd be great. Yeah, very nice to meet you, of course. Yeah.
Thank you for such a nice talk.
Oh, my pleasure.
I would like to have this time, even though I'm well not qualified to be your side. Now, one simple question. Since you based on long and historical base
Yes.
how are you going to deal with this technology markets? Basically, a lot of little components into
Right. Oh, it's a great question. You can rely on history, but only so much. I mean, part of though with China is you look at long-term history, right? And so if I look at history and I define history starting in 1945 to present, but if let's say I look from the 1600s until now, and say, what economies were actually the largest in the world, historically over long periods, centuries of time. Well, China has actually been the world's largest economy for most of human history, except for this strange period of the last 100 years. And so China's kind of return to that prominence to us isn't like a weird new thing. It's actually a return to normal. And so, it's a long way to answer your question, but we don't think that China becoming such a big part of the world GDP is something that we should think of as surprising. We should think of that as more of a return to, especially given the population.
now. The other question is about the consumer. For whatever reasons, to compare with the people in changing, the less property ownership compared with 30 years ago. upper 60s now, it's came back down to 60. So sometimes the gap of childhood care on average is low. So you accounting for a lot of those things, adjusting.
Yeah, you have to look at those long-term trends and demographics or other trends.